So if you've been trading for months, maybe even years, and you're still not consistently profitable, this video might be uncomfortable to hear, but it could also be the most important one for you to watch. Because the reason most traders lose money has nothing to do with intelligence, luck, or even strategy. It's about how they were taught to think about the market. So in this video, I want to break down why most Forex traders lose, what institutions do completely different, and how I personally simplified my trading using price action and Bollinger Bands, not as signals but just as a context, right? So this is not a hype video, this is not a get rich video, this is an educational video meant to help you see the market more clearly. So before we continue, a quick disclaimer: this content is just for educational purposes only. Trading involves risk and nothing here should be taken as a financial advice. Always manage your risk and trade responsibly. So I've been on both sides of trading. I've overtraded, I've chased setups, and I've blown small accounts. And I've also learned how to slow down, simplify, and approach the market with structure and patience, using simple price action and Bollinger Bands without overcomplicating things. So what changes everything wasn't a new indicator, it was understanding why most traders fail to trade and fail to make profit in the first place. So let's start with the uncomfortable truth. So most traders lose money because they are trained to trade like the crowd. So here are the most common reasons. So the first reason is that most traders feel the need to always be in a trade, right? This one is the first one. Most traders feel the need to always be in a trade. If the market is moving, they want to participate. They even want to be there even when there is no setup, no clear setup. But professional traders don't trade often, they wait, right? So this is the first point. The second point is that indicator addiction. Retail traders, they stake indicators on their charts, the RSI, the MACD, the stochastic moving averages. They hope confirmation will remove the uncertainty. They hope that they hope that they get a lot of confirmations so that they trade, but then it actually removes uncertainty. So I want you to understand that indicators are lagging, right? Institutions don't need 10 confirmations, they read price itself. So that's the other thing that you need to understand. And then the next one is that many traders focus only on how much they can make, not how much they can lose. So this is improper risk management. So one bad trade should never wipe out weeks of progress. Risk management is not optional, it's the foundation. It's actually the foundation, right? You must always be a very good risk management trader, right? And then the other thing is emotional trading. So people usually trade with fear, greed, and even revenge trading. So these emotions, they destroy consistency. Most traders don't lose because the market is unfair. They lose because they react emotionally instead of executing a plan, right? So if this is how most traders lose, how do institutions think differently? I need you to understand this thoroughly so that you can be profitable. You can actually trade like an institution, not like the crowd, right? So institutions don't trade predictions, they trade probabilities. They are not trying to be right, they are trying to manage risk. So the first key difference is patience, because institutional traders are comfortable doing nothing. They are actually comfortable doing nothing. They can just sit back, watch the market, and do absolutely nothing. That's the first key difference. And also, they wait for price to come to areas of interest instead of chasing it. So you must always be ready to look at the price and wait for it to visit your area of interest, right? And then the second key difference is that structure is better than indicators. So the institutions, they focus on market structure, high highs, lower lows, ranges, and breaks. So indicators are secondary. If you are actually to use them, they must be secondary. The first thing that you must consider is the market structure. Like I did in my previous video, I was trading using pure market structure, and then I used an indicator as a secondary confirmation. That is how you can trade like an institution, right? And then another key difference is the liquidity, right? Not signals. So institutions understand that price moves to areas where liquidity exists. So retail traders they chase breakouts, but institutions often trade after retail traders are trapped, right? So this usually is how institutions trade, because usually retail traders enter the market and then they are hit by the stop hands. So institutions enter just after those stop hands, or when the retail traders are trapped. That's how they make profits. And then another key difference is they know their risk before entering any trade, right? If the risk doesn't make any sense, the trade doesn't exist, right? So before you even enter in any trade at all, you must always understand the risk that you're taking before you even enter a trade. That's how institutions trade, and I need you to understand how institutions trade so that you can just like the crowd. So another thing, I need you to understand the strategy, right? So this is where simplicity becomes powerful. You don't need to trade like a bank, but you can think like one, because a bank is an institution that has a lot of funds, right? I just need you to think like a bank, but you don't need to trade like a bank, right? That's how you can be profitable. So these are the difference that institutions have from retail traders and the crowd, right? So I personally simplified my trading with these core strategies, right? So I started with structure, right? This is where we look at where the price is trending. Is it ranging, or does it have higher highs and higher lows? And without structure, indicators are meaningless, because structure is the most important thing in the market, right? So I personally use Bollinger Bands as my indicator. It's just a context, right? Not signals. I don't use Bollinger Bands to buy or sell blindly. I use them to understand volatility and context. So when price is expanding, I'm not fighting momentum. And when price is contracting, I'm more patient. You must always remember that. The bands help me see when the price stretched relative to recent behavior, right? And also the alignment. I only pay attention when structure and context align. So these two things, when the structure that I have analyzed and the Bollinger Bands have aligned, that's it. That's where I trade, right? No over analysis, no forcing trades. You must always remember that. And then I would actually advise you that if you are struggling with consistency, here are the few things that you can do that can help immediately. So you need to trade fewer setups and make sure that you trade more quality setups than quantity, right? You must always prioritize quality over quantity when you are trading. And also risk at least 1% or even less per trade. That's very, very important. And I need you to journal every entry. I'm pretty sure I've said this before in my previous videos. You need to journal every trade, right? Including emotions. Even whatever that you did in the market, you need to journal it and make sure that it improves you in the next trades, right? Whether it was a win, whether it was a loss, or maybe just an analysis, you just need to document all those things, including the emotions that you had at the time you were analyzing or at the time you were executing that market. So you need to stop watching every candle, right? You must give your trade some space. If you are holding, you must give the trade some space. You must exit the MetaTrader 5, the trading view, or whatever platform that you are using, and do something else. Just go out there and do something else. Don't watch every candle, right? And also accept that losses are part of the process, because without losses you can never be a trader, right? So this is where consistent come from. Like consistent, it comes from discipline, not excitement. Whether you have lost, whether you have won, what's important is that you are disciplined. That's actually what helps you to be consistent, right? And the mindset that you have, the market doesn't owe you anything. I need you to remember that the market doesn't owe you anything. Once you stop trying to force money out of the market and start letting probability and patience work for you, everything changes. Everything changes. So trading becomes calmer and decisions become clearer, right? Your mistakes become lessons. These are very important tips that I personally chose, and I personally thought they can help me in my trading, and I decided to share them with you because they are very, very important, right? So if this video helped you to see the market differently, consider subscribing to this channel. And once we reach 10,000 subscribers, I'll be starting live trading sessions right here on YouTube with real market conditions, real analysis, and a real-time decision making. No edits, no hype. So remember, the goal isn't to trade more, but the goal is to trade better. So thank you guys for watching. Manage your risk, and I will see you in the next video.